The last 12 months saw continued strong liquidity in the Irish investment market as deleveraging efforts continued at pace. Robust demand prevailed for the various assets, portfolios and loan sales offered to the market during the year. Buoyed by impressive occupational activity, an improving domestic economy and rental growth expectations, more than $3.5 billion of investment in commercial real estate was recorded last year. Although somewhat less than the $4.5 billion recorded in the previous 12-month period, this masks the large volume of properties sold by way of loan sale during 2015. This includes the Project Jewel loan sale, accounting for $1.85 billion in its own right, which was counted separately. There was a distinct change in the buyer profile over the course of the last year as more long-term institutional investors emerged, including several new entrants from overseas. One of the key differences in 2016 will be a somewhat lower volume of transactional activity as the market moves back to more normalised trading levels following 3 years of frenetic deleveraging. As deleveraging efforts wind down, it is inevitable that a greater proportion of transactional activity in the Irish investment market will emanate from secondary trading, as some recent buyers, such as private equity firms, implement their exit strategies, and many of the assets and loans purchased over the last number of years are retraded. We also expect to see continued activity in terms of loan sales in 2016. However, with the Irish investment market now clearly core as opposed to opportunistic, it is clear that in addition to acquiring additional assets, investors are increasingly focusing on maximising income generation from existing assets and exploring potential development opportunities. With prime yields now at or close to a trough and likely to start to drift upwards in line with the interest rate cycle in due course, it is inevitable that returns from Irish commercial property will ease somewhat in 2016 compared to the extraordinary returns achieved over the last few years as the Irish market rebased following the most severe correction it had ever experienced. Returns in 2016 will therefore largely be generated from income and rental growth as opposed to yield compression. We expect to see several high-profile office and retail assets being traded during 2016, although for the most part these will be offered individually with less portfolio sales anticipated compared to the last number of years. Offices in Dublin CBD and suburbs, prime retail and prime industrial assets are likely to offer the most attractive returns in 2016, considering the potential for rental growth in these particular sectors. In addition to an increasing number of investors seeking to move up the risk curve into new sectors in order to enhance returns, we envisage much greater emphasis on high-yielding development projects as the year progresses, with particular focus on office, hotel and residential schemes, and to a lesser extent retail and industrial development opportunities. We therefore expect to see an increase in forward funding transactions emerging this year. Although obtaining debt for speculative development is expected to remain challenging this year, the Irish market is now more institutionalised, with ownership largely in REITs, pension funds and institutions that are not wholly reliant on obtaining debt to fund development. We expect to see continued improvement in the availability and cost of debt funding for prime income-producing investment opportunities over the course of the next 12 months. However, we expect that the availability and indeed the cost of debt funding for secondary and relatively small lot sizes will remain constrained and prohibitively expensive for some time yet. We anticipate continued investment from Irish and European institutional buyers in 2016, and we also expect to see continued appetite from US buyers. While there are understandably concerns about Chinese investment at this juncture, considering the precarious economic situation in China, we expect to see an increase in Asian interest in the Irish market during 2016, predominantly from Korea, Singapore and the Middle East, particularly if large lot sizes are presented for sale. We are likely to see the emergence of some new specialist funds over the next 12-month period, and there's also the possibility of additional specialist Irish REIT vehicles being launched this year. Although we are in a more mature phase of the Irish investment market and cycle at this juncture, the difference between this and other cycles is the significant yield gap that persists in this unique low interest rate environment, which is likely to continue in the short to medium term. Even when interest rates start to increase, as they ultimately will, They are not expected to rise dramatically. The gap between bond rates and commercial real estate returns will therefore remain elevated for some time yet, which will continue to support the market over the medium term. Although growth won't be as spectacular as that generated over the last 2-year period, very strong returns will be achieved in the Irish commercial property investment market in 2016. We are now entering a period where the Irish investment market will be focused on generating returns from income and rental growth as opposed to yield compression, which is ultimately more attractive to long-term institutional investors than a cyclical market driven by the weight of capital.